Welcome to today's webinar, which is all about why investing is important. My name is Melody Morgan, and I am head of Evergreen Content here at Saxo. And today I'm speaking with Ida Johannesson, Saxo's head of ESG and education. Hi, Ida.
Hi, Melody.
How are you?
Good, thanks. You?
Good. So today we are going to cover a few things. So I want to show you the agenda. Get that up for you. First, we're going to talk about what is investing and why it's important. Then we'll cover the difference between saving and investing. Then Ida is going to talk to us about risk tolerance and suitable investments for the different types of investors. She'll also share with us practical tips to get started. And at the end, as long as there's time, we'll have a little Q&A session. So if you want to enter any questions that come up for you during the webinar, there's a little prompt on your screen where you can do that. But before we get started, there are some important things I need to read off to you, legally speaking. Information presented here is for educational and informational purposes only, and it is not a recommendation or an offer or solicitation to buy or sell any securities. Investing in financial products involves risk, including risk of loss. And as a general rule, you should only invest in financial products if you understand the risks associated with them. Past performance is no guarantee of future results. And before investing, you should always consider your investment objectives, time horizon, and risk appetite. All right, now that we did that, let's get started.
All right.
So, Ida, first, can you explain to everyone exactly what investing is?
Yeah, definitely. Okay. Now, investing means to buy and sell investment products, things like stocks, bonds, or funds, with the expectation of making a profit. Investing is best suited for the medium term and the long term, and it is risky. Of course, investors go into investing hoping, or rather expecting, to make money, but it's not guaranteed and they can actually lose money.
Okay, and so can you tell us why it is important to invest?
It is important because it has the potential to grow savings over time. It has the potential to build wealth. Investing is used to achieve a variety of very important goals, like planning for your retirement or paying for your kids' university education. With financial security, you have more choices and options in life and less financial stress.
Yeah. So there's many people who understand the benefits of investing logistically, intellectually, but they actually feel more comfortable saving their money instead of investing it. So what are your thoughts on that?
I get that totally. Myself, for many years, I did not invest. I saved instead. And that is because I was afraid of losing money and I did not know where to start. But there's something that I found out pretty quickly after I started investing, and I think people should be aware of. And that is, there's a cost of not investing, an opportunity cost. And over the years, that cost can get huge. I will show you an example, Melody. Let's say 10 years ago, you had 10,000 euros and you decided to save it. Well, today, after 10 years, you would have about 10,500 euros in your account. And this is assuming a 0.5% interest rate on average per year. Now, if you had instead chosen to invest, let's say in the S&P 500, today you would have 30,782 euros. And this is assuming an average annual return of 12%, including reinvested dividend. So the difference is quite huge at over 20,000 euros. And let's just say that instead of 10 years, it had been 20 years, then the differences would be even larger. We're talking about 12,200 with savings and over 64,000 with investing. So the difference here is over 52,000 euros or dollars, whatever currency applies to you. And this example really illustrates the power of investing, the power of compound return or compound interest.
Okay, and so the results that you're showing us with the S&P 500, Is that only for experts or financial professionals, or can anybody get that?
I think nowadays there's easy access to online brokers, there's easy access to good financial education. And so anyone who takes advantage of those resources can be a successful investor. Now, can we all achieve the S&P 500 result? Well, it depends on the investor's risk tolerance, the investor's time horizon, and even the timing of their investment. All this to say, you do not need to be an expert, but you need to be invested, you need to remain invested, and you need to have the required risk tolerance to invest in something like the S&P 500, which is essentially equities.
Okay, so can you talk to us a little bit about what risk tolerance is and why we should care about that?
That's a very important point, the risk tolerance. I think in order for an investor to figure out the type of investor that they are, and ultimately the type of investment products that are suitable for them, they need to understand risk tolerance and they need to understand their own risk tolerance. Now, the risk tolerance is two things: the willingness to take risk and the ability to tolerate risk. The first part is influenced by people's personality. Some people are risk seekers. They love to take risk. They might be the type that drive really fast on the highway or that jump from airplanes, skydivers. And then you have other people who do not like risk. They are known as risk averse because they avoid risk. They have an aversion for risk. And this type maybe prefers to take a walk in the woods and not climb a mountain. Now, the second part, the ability to tolerate risk, depends on a number of factors, things like somebody's financial situation, someone's age, and someone's time horizon. Essentially, the more financially stable you are, or the more money you have, the more risk you can tolerate. Let's say we have two investors, one with a portfolio worth 5 million and the other one with a portfolio worth, let's say, 100,000 euros. If they both lose 50% of their portfolios, of course, it would suck for both of them. But the one who's left with 2.5 million can still have a decent life. They might have to make some drastic changes and downsize, but 2.5 million is a decent amount. But if you started with 100,000 and you end up with 50,000, I think you'll be in a bit more trouble than the other person. The second thing is the age. The younger you are, the more risk you can tolerate, because if you lose money, and you might, it does happen when you invest, you have more years ahead of you, we hope, to recoup your losses and rebuild your portfolio. And lastly, there's a time horizon. The longer the time horizon, the more risk you can tolerate. Now, there's different types of goals in life. People have short-term goals, medium-term goals, and long-term goals. And if you have a long-term goal, which is something like retirement or saving for your kids' education, you can afford to invest a bit more aggressively than someone who has a mid-term goal. Let's say they want to buy a car in the next 5 years. Now, the risk tolerance is not something that stays fixed throughout your life. It does change as you go through life events. It could be that you start having kids, or you get married, or you are getting close to your retirement age, or it could be you lose your job, or you inherit a lot of money from your parents. Now, there's one thing with the risk tolerance. Based on risk tolerance, investors are put into three main categories: conservative, balanced, and aggressive investor.
So for someone who's new to investing, they may be wondering, is it better to be a conservative investor? Is it better to be a more aggressive investor? Can you talk to us about that?
Yes, it doesn't really work like that. It really has to do with the person. A conservative investor values safety and security. They do not want to take a lot of risk, and they want to preserve their capital. An aggressive investor tends to want to outperform the market and reach their goals faster. No one category is better than the others, What is important is that as an investor, you invest in products that reflects your risk tolerance and the type of investor that you are.
So are there different types of products that are more suitable to the different types of investors?
Yes,
Okay.
and we're going to talk about that. I have a slide here for you. Now, whatever an aggressive investor invest is not necessarily suitable for a conservative or a balanced investor. Of course, there are overlaps, but generally, for a conservative investor, suitable investments include things like government bonds, money market funds, and then certain equities, I would say high quality equities from well-established companies in sectors like utilities or wealth or healthcare, but not technology.
Okay.
For a balanced investor, suitable investments include things like corporate bonds, stocks, mutual funds, and ETFs. And for an aggressive investor, it would be stocks, high yield bonds, mutual funds, and ETFs, but also complex products like exchange traded options, contracts for difference, FX, commodities, and leverage and inverse ETFs. Now, for complex products, it is very important that before you start trading those products, you have the required knowledge and experience. In the EU, a financial institution like Saxo is required to offer you an appropriateness test. And actually, at Saxo, it is mandatory to pass the test before you are permitted to trade those products. Those products have a high potential of return, but they are also very risky.
Mm. Yeah, that's very important. Um, so a lot of people have many different competing priorities in life financially, like paying tuition or paying off a mortgage. So how can someone actually bring investing into their lives when they have so many monthly and annual expenses already?
First of all, I'd like to say that before you start investing, you should have your finances in order. You
Mhm.
should be responsible financially. And this simply means that your expenses should not be above your income. Now, there's two types of expenses. We have essential expenses and non-essential expenses. Essential expenses are things like your rent, mortgage, if you own your place, food bill, utility bill, and transportation. Non-essential expenses are things like entertainment, going out to the movies or going out to dinner with family and friends, buying fancy clothes, your gym membership, your Netflix subscription, and vacation. Those expenses are not essential, but we make them a priority because we enjoy them. Well, investing should be treated like those expenses. We should make them a priority. Financial security should be a priority. And the good thing with investing is that if done well, it can actually make you use the money that you need to pay for your non essential expenses and finance your lifestyle.
Yeah. So if someone's watching today and they feel like, okay, I'm ready to get started, what should they do first?
So there's a few things that people should do, and I have a slide here for you. I've broken it down in 3 steps. Yeah, sorry.
Yeah.
The first step is you need to open up an account. The second step is you need to fund an account. And then lastly, you need to build a portfolio. Now, if you are lucky enough to live in a country where there are tax advantage accounts, you should start there. A tax advantage account is an account that offer advantages such as tax exemption, you don't pay taxes, tax deferral, you pay taxes later, or lower taxes. And so you should start with this type of account and then open a regular brokerage account. The second thing you need to do is you need to fund your account. If you do not put money in the account, securities would not magically materialize there. So that's a very important step. Put the maximum allowed by law in the tax advantage account. And if there's any money left, then you can put it in the regular brokerage account. And the third step is to build a portfolio. Now, this is a very important step. And for that reason, we have an entire session dedicated to how to build a portfolio in 2 weeks, where my colleague, Sharu, who is the head strategist in Singapore, will go over things like asset allocation, diversification, and how to select instruments. We do not have a lot of time left today for me to do it justice. But what I can say is building a portfolio is not about randomly selecting securities. It's really about putting together a mix of securities across asset classes, across sectors, and even across geographies that fit your goals and your risk tolerance. What is important and that you need to ensure of is that the portfolio is diversified and that you do proper research. Don't just buy names based on your friend's recommendation or the taxi driver's recommendation.
Yeah.
Do your research.
Yeah. I also want to go back a little bit because when we were talking about, you know, annual expenses, monthly expenses, going to open an investment account, there's also people who think about, okay, but don't or should I have an emergency savings account? Things like that. So, is that important? Does somebody have to have an emergency savings account before they get started? And what are your thoughts on that?
An emergency account is, as the name indicates, an account where you keep cash, and I mean cash, not securities. You keep cash to cover unexpected expenses, things like you lose your job, or maybe you have unexpected medical expenses if you live in a country where the coverage is not complete. It is recommended that you keep between 3 and 6 months of your fixed expenses. If you live in a country like Denmark, where there's good social security and decent unemployment benefits, maybe 3 months is enough. If you live in Dubai as an expat, or maybe in the US, then maybe you need the full 6 months, or maybe even more. It really depends on what makes you feel good.
Yeah. Okay. And what about if somebody has debt? Do they need to wait to completely pay it off before they get started investing? Or can they pay a little bit of it? Or what do you think about that?
Yes, I actually have a slide on this, so I'll just get to that.
Okay.
Now, if you have debt, you must pay your debt. I mean, this is what a responsible person does.
Mm.
And I put that into the essential expenses category. But what you must pay, and is part of the essential category, is not the entire debt, is the minimum required payment, which is usually charged on a monthly basis. Now, should you pay the entire debt before you start investing? The answer is it depends.
Yeah.
If the interest on the debt is above the expected return on your investment, you should pay off the debt first. I have a credit card, and every month I pay the full balance because the interest rate is above 20%, which is way above the expected return on my investment, which is closer to 10. So in this case, it would not make sense for me to invest the balance. I pay the balance in full. Now, the second thing is if the interest rate on the debt is lower than the expected return on your investment. Here, we recommend or we suggest that you consider investing. I have a house, I have a mortgage, and there the interest is below 2%. So I've decided not to pay off the loan entirely, but I've decided to invest instead. But there's one thing about the second case, and that is if the interest rate, even if it's below your expected return on investment, but if it's above or equal to 6%, you should prioritize paying off the loan. That is just a suggestion, a rule of thumb. And the reason why it is recommended to pay off the loan, it's because 6% is a relatively high interest rate. And with investing, we're talking about expected return, not guaranteed return. So if it's 6 or above, you should maybe consider prioritizing paying off the loan and not investing.
Okay. So we've talked about the different types of investors, risk tolerance, time horizon, emergency savings accounts, how to actually get started. But what if someone listening is like, okay, I think I'm finally ready. I think I'm about to do this, but they're still scared. So do you have any tips for someone to overcome that fear of actually, you know, investing?
Maybe you should talk to a psychologist.
Yeah.
I don't know. No, joke aside, I think actually Melody and I talked about it a few days ago. I think knowledge is power, and you should try and educate yourself. Find out about what investing is, find out about the different investment products. On the platform and website, we have lots of resources and guides that can help you. So if you are curious, definitely use those resources. You could also join events like today's webinar. We have a whole series designed just to help you get started and to give you the tools for you to do it on your own successfully. You could also join communities of investors. I think those are particularly good because they can give you the encouragement that you need to get started or even to try things that you would normally not try. And then lastly, I would say just do it. I mean, start small, but do it. And if you do it well, hopefully you would realize quickly that it's not as scary as it looks, and little by little keep adding to your portfolio. Now, there's one thing that I want to say before I give you the floor back, Melody. It's this. They suggested portfolio allocations for the different types of investors. And as I said before, it's not the same investment products that are suitable for all of them, but it's also not the same allocation that is suitable for all the type of investors. For a conservative investor, the bulk should go into bonds and cash. As we can see here, 65% in bonds, 15% in cash, and only 20% in stocks. And if we go all the way down, an aggressive investor should invest mostly in stocks. And we have 85% in stocks, 10% in bonds, and 5% in cash. These are not recommendations. These are just general guidelines that you can use when you start your investing journey. If you are conservative, okay, where should I put my money and in which asset classes?
Okay. Awesome. Well, I wanted to see if there's any questions that we should ask, and we do have a few from people watching. Um, Here's one. What's the difference between mutual funds and ETFs? Someone wanted to know.
Okay. There's many similarities between mutual funds and ETFs.
Okay.
They are both diversified investment vehicles. They are a pool of or a collection of securities. Sometimes the mutual fund or the ETF invest exclusively in stocks. Sometimes it's a mix of stocks and bonds. The main difference between ETFs and mutual funds is that mutual funds are actively managed. They aim to outperform a benchmark, whereas ETFs are passively managed. They just aim to deliver the same performance of the benchmark. When it comes to cost, ETFs tend to be less costly than mutual funds. And then there's also something else that is very important. It's the taxation. Mutual funds tend to distribute more capital gains and dividends than ETFs. And at the end of the day, it makes a difference to you as an investor because it affects the taxes that you would pay on a yearly basis.
All right. We are getting a lot of questions in right now. Is there anything else you want to say about
No,
mutual? Should we get okay? All right. Nikos wants to know, should investing in gold ETFs be a part of a balanced investor's portfolio?
I would say yes. If you invest in, let's say, an ETF, a gold ETF, you can definitely put that in a balanced portfolio. Of course, the allocation, I would say, should not be above 5%.
Okay. Um, Sarah wants to know, what do you mean by allocating cash to the portfolio?
Cash is an asset class, just as stocks and bonds are. So you keep a portion of your portfolio in cash. Now, back to the slide that we have actually on the screen. If you already have an emergency fund and you are comfortable with the amount that is there, you don't necessarily need to keep cash in your portfolio. That allocation to cash could actually go into your bonds allocation.
Okay. What are the most common mistakes new investors make? How can they be avoided? That is
Ooh.
coming from Johnny.
Common mistakes, from what I've seen, is not diversifying their portfolios.
Yeah.
That's a big one. Lots of people buy based on friends' recommendation or sitting in a cab, and then the taxi driver starts talking about Tesla or Nvidia. And then you end up with a very concentrated portfolio that is probably not aligned with your risk tolerance and profile. So it's very important to diversify your portfolio. Mistakes that people make, they don't do enough research. Again, it's only based on friends' recommendation, and that is not enough if you are aiming to reach your financial goals. I mean, investing is a serious business. It's not that it's so serious that you need to know a lot about this, but this is about your money, so you should take it seriously and not just buy things randomly. Another mistake that people make, I would say, would be that they sell too quickly when things go south. People panic, even if they have a plan. And when they go into buying those securities, the plan is, I'm going to do this, blah, blah, blah. This is my risk tolerance. But when things get a little bit shaky, they sell. And when you sell, you materialize your losses. And by the time you come back, you might have missed some of the best days in the market. So I would say, if you have a plan, stick to your plan.
That's good advice.
Another mistake, I would say, people do not, they don't prioritize investing. They don't regularly allocate money to investing. Yes.
Yeah. All right. Well, we're getting a lot of questions in. Okay. Okay. John is asking, if I am trading, is there a range of period that I should usually take action? For instance, every 2 weeks or 3 months?
I think it really depends on the investor. It depends on how much money they have also. I mean, I invest, I would say, every 3 months. That's when I look at my portfolio, and I allocate a portion of my income every month to investing, but I do not necessarily make an investment every month. It could be that I do it every 3 months. So it really depends on the investor, how much money they have, how large their portfolio is, but also the type of instrument that they have in their portfolio. But I would say a monthly frequency is decent for an investor.
Yeah.
If you are a trader, that's a different story.
Okay. As a beginner, what are some reliable resources to learn about bonds and stocks? Stephanie is asking.
Reliable resources. I think there's tons of things available on the internet. I mean, I can talk about what we have at Saxo, but I am biased, of course. But
Well, we should be biased. But they can go to the inspiration tab on our website. If you click that, there's so many resources there.
Exactly.
Learn about everything.
Yeah, Melody just
plug
said it. Yes, we have a lot of inspiration available on our platform, so you could start there. But if you want to read more, I mean, the internet is huge.
Yeah, it's big.
Yeah.
Okay, there's more questions. What is the best approach for a parent to educate an adult child in value investing?
An adult child in value investing. Is it the question
That is
about
the
value
question. Does that
investing?
mean a child that's living at home or an adult child?
Okay, well, I think the same would be with a small kid.
Yeah.
Excuse me, I have a bad cough, so in advance, I apologize for coughing at times. It's about talking to them. I mean, I think you should talk to them about the importance of investing, showing them numbers like the example with the S&P 500 and saving, explaining to them why it matters, why it is important, guiding them toward educational content. And as I said before, there's tons of good educational content available. We have good content on Saxo's platform, so you can also tell them to take a look at our platform
Or the website too.
or the website.
Yeah. Gotta say that.
Yes.
Um,
And then I think there was something else
Yeah.
about value investing specifically.
yeah,
It's kind of odd that we are just focusing on value investing, but value investing is essentially buying things that are undervalued. So talk to them about buying things that are cheap and not maybe growth stocks where the prices are already inflated. That was a question, so I just wanted to make sure
Yes.
to answer that.
Yes. Okay, I'm just going through more questions. Is it ever too late to start investing?
Too late? No.
Yeah.
Late? Yes. You can be late, but it's never too late.
Yeah.
As long as you have goals and you have time on your side, it's never too late. But also, if you think that maybe if you feel that it's too late for you, I'm pretty sure it's not too late for other people in your life. It's not too late for your kids. So maybe you start there. Or if you don't have kids, maybe your nieces and nephews.
Mhm. Okay. That might be it actually from
Okay.
the questions. But we wanted to ask everybody to please help us out 2 minutes of your time and fill out this survey with this QR code. That would be really, we'd be very grateful if you did that. Is there anything else you want to say about just getting started and doing it, jumping off?
I guess, yeah, I think it can look scary to start investing or to be an investor, but it's actually not that scary. And the benefit can be life changing. So I think it's really something that people should consider if they have some money aside, if they are responsible financially. I think it's definitely something that people should consider investing.
Mhm.
It can change your life.
Yeah.
I said it to somebody not too long ago. Money does not bring happiness, but it helps. Yes, it does.
That is a good note to end on, I think. I do. Well, thank you everybody so much for joining us. We hope you have a great day and we hope you'll visit our website and platforms to learn more and empower yourself, educate yourself, and get started. We hope you have a great day and please join us for our next webinar in a couple weeks.
Thank you, Baladi.
Yeah, thank you.
Yeah, it was great.
Yeah. Bye, everybody.